First of all, good afternoon, and thank you for joining us today. This is our third webinar since the COVID-19 crisis began, and I would say without question, doing these webinars has been one of my favorite parts about the last 60 days. And I love these because it gives us a chance to round up some of our longtime friends, clients, real estate contacts, bring them all together in one place, and then just have them share their insights and wisdom with all of you. And over the years, these relationships have blessed me immensely. And judging by the overwhelmingly positive feedback we have received from our last couple of webinars, these have been really impactful for many of you as well. So thanks for making time for us today. I think it's going to be really time well spent. We are recording this, and we'll get a copy out to you all. If you missed some of it or have to drop off early, we will get a copy out to you all here in the next couple of days. On today's webinar, we have my good friend David Moore with us, and we are going to structure this one a little differently than we did the last couple. We're going to spend the first part of this webinar just talking to David, hearing his story, hearing his thoughts about the market today, seeing what his crystal ball says about the coming months ahead. And then I'll turn it over to my friend Paul Peebles, who will talk with Mark Cantrell of CMI about 2020 property taxes. He'll talk with Patrick Nugent about rising insurance costs and what that means and looks like for your P&Ls moving forward, and practically speaking, what happens if there's hail damage, et cetera. And we'll also talk with Brian Hammer about evictions and some of the other COVID-19 legal questions that people keep having and bringing up. And then James Ng will pop on and just give an update on the capital markets and what you can expect out of in the debt world in the near future, and see if any of these lender required reserves are going to let up anytime soon. So before we dive in with David, I just want to point out there is a Q&A function at the bottom of your screen. There's 3 little dots. And if you click on that, you can access the Q&A function. Bard Hoover, my business partner, is in the background here. He's monitoring those questions as they come in. So if you want to ask David a question, don't use the chat feature. Use the Q&A function. And at the end of our time with David, and then at the end of our time with the other folks as well, we will have time to take a few of the best questions we receive. So without further ado, let's get right to it. And David, thanks for joining us today. So for those that don't know David is the president and co-founder of Knightvest Capital. In the last 10 years, Knightvest has bought more than 110 properties, totaling more than 40,000 units, and become one of the larger owners in the country. And if you really break that down, that's really the equivalent of buying a deal a month, basically for a decade. And these aren't small deals. These are 350 plus unit deals. So it's really a great success story. And one of the reasons we asked David to come on today is I knew David at the beginning of the Knightvest years. And it's just his story is great. And I think there's a lot of encouragement there for a lot of folks on this call. And you'll find out shortly that 10 years ago, David was really not any different than anyone on this call. And so, David, thanks so much for being with us. I know you've got a lot going on right now. And so tell us a little bit about how you got your start in multifamily, and how did Knightvest kind of come into existence?
Sure. And it is crazy. I've never put in perspective of a deal a month for a decade, but we bought a few portfolios, so it's a little misleading, but we have been, we've certainly been busy. So we bought our first deal at the courthouse steps in 2008. So Casey Cronbach and I, we're the founders of Knightvest. We were basically unemployed real estate guys with no money. We're both married with little kids, trying to figure it out. I'd just gotten laid off of a private equity firm here in town, and literally it's a scary time. So it's, similar to what some people are going through right now, obviously without the health issues. But so we started just trying to literally make a living, and we were flipping houses. So we were buying houses at the property tax foreclosure. We cashed in our 401ks, literally had no money. I had more credit card debt than cash. And I think that was the same for Casey. So we were at the property tax foreclosure in 2008, and the constable stands up and says, I've got a 44-unit property that we're going to auction off. All I know about it is there is a structure on it. There are people living in it. And we're going to start the bid at the tax valuation, which is $488,000. And Casey and I aren't even really paying attention because we have like 20 grand in our boot trying to buy a house. And constable says, we'll start the bidding at 488. No one bid. And then he said, open bidding. And some guy in the front row said $100. And for those that you know, Casey and me, we probably got a little carried away on the auction process. And, we walked away with that property and another little property, basically 44 units for like $12,000. And that is not per unit. That is total. We had a big education on what lien did we buy. So we thought we had a superior lien. We had basically a weed lien. So we had to work it out with the senior lender that we didn't know existed, and had to work it out with the taxing authorities that they hadn't paid, which we didn't know existed. And that's how we got in business. We literally started, we had no rent roll, no keys. After that auction, we're in business. Nothing to do. So we literally went down there and knocked on doors, collected rent. It was, believe it or not, for 12 grand, you don't get a nice property. It was about as rough as you can imagine. And that's really, that's how we started.
So once you got past the courthouse steps and started saying, hey, I think I'm going to try to make a career out of this multifamily thing. As far as an on-market type transaction, what do you remember about your first transaction? As far as earnest money, raising equity, what kind of debt you were going to put on it?
Yeah, so we realized it's like we think this is a viable, at least next phase of our career, we can make a living. So we clearly needed a bigger deal. And so there was a property on the market that was 300 units. I think it was for $9,000 a door. Called the broker. Broker wouldn't call us back. But I think the broker is on here. He's a good friend of mine to this day. Wouldn't call us back. And we finally said, okay, we like it at this price. I think that was in the days when brokers put pricing on packages. They haven't seen that in a long time. It's like, we like it at this price. We will sign. And this is a story. This is not what I recommend. So don't do what we did. But we said, we will sign the contract as is. And we put up, I think, $50,000 non-refundable. And we told them to send us the contract. We'll sign it right now. And they sent us the contract, signed it right there, sent in 50 grand. And then the next phone call is, Casey and I were talking, and we're like, do you know anyone with money? And he's like, no. I was like, me either. So anyway, we set out to raise money, and we knocked on doors. So, I mean, we literally, knocked on anyone that would listen to us. And we needed an extension. This is how, again, a story I don't recommend. We needed an extension, and per the contract, it's $25,000 to extend. And I remember going home and telling my wife, saying, we need to see what we can get from our credit cards. And, so we pulled out all our credit cards and started calling American Express. How much cash advance can we get? So we did that. And finally I was like, okay, put them away. This is crazy. Called the seller the next day and said, listen, you have all our money, literally. We have no more money, but we think we can get it closed. And sure enough, we got it closed a few weeks later, and that became our new day job.
Yeah, that's amazing. That's amazing. So you'd just been, laid off of your kind of corporate America job. You're coming out of a recession at this point. I mean, was that in the psyche at all? Is this a good time to be buying, or what was the mindset, about buying a deal in 2009?
Yeah, I mean, it's funny. We never hit that time. Maybe a couple times, but not many, where we said, wow, we're going to crush it here. It's like every deal, no matter what, even when we were underwriting in 2009, 2010, it's like, wow, we're paying a lot for this. I mean, this is a tighter deal. Now, obviously, hindsight's amazing. We go back and look at underwriting, and its assumptions are laughable. I think our original model didn't even have rental increases. I mean, we're, buying things that are 60% occupied. Rental increases were the last thing on our mind. It's how do we get boarded up apartments livable?
Yeah. So what about, and just an operational question, were y'all managing your own deals from the start? Did you have third party management? How are y'all doing that?
No, that was our only source of income. So we did the property management from day one. Casey and I we kick the manager out of the leasing office, and whoever got to work first got the good side of the desk in the on-site leasing office. So we didn't know any better or know any different. And so we would office, when we bought our second deal a few months later, we would just split time, bought our third, fourth, fifth, sixth, probably up to 10 deals. We literally would just property hop and just be like, this is free rent. That's how we did it.
Wow. All right. So over time, in some of these first deals, and I've sold a couple of these deals for you back in the day. So I got a up close view of these Class C chiller deals, flat roofs, like you said, not necessarily best locations in town, not easy deals. Now, over time, you have shifted focus into, buying nicer B deals and now even buying A deals. Tell us about how that kind of came to be. How did you transition from value add Class C stuff to Class A?
That's a good question. I mean, we don't buy too many true Class A. We have a few, but I wouldn't say that's our typical, maybe our ongoing business plan. But we did make the concerted thought, and I can't remember who I talked to, but someone gave me the advice of, as soon as you can get out of the true C space, and this is our first deals, I would say we're on the very, very low spectrum of C, and that assumes there is no D space, if that makes any sense. So we were in the very, very low Cs. I mean, dodging bullet Cs. And so we made the concerted effort to, hey, let's try and get to the B space when we can. It's just a little more, there's a little more stability of the tenant you're going to put in is not the same tenant that you just kicked out with a different name. And so we probably made that switch, I would say 3 or 4 years in, so that's 2012, 2013. And we've been buying the bulk or Bs. We've bought a few Cs, even the last few years. We bought a few, quote unquote C properties. So we still will, but the vast majority are kind of a B plus.
So now, as you talked about your early stages of underwriting and how that's evolved, and I can totally relate because I go back sometimes and look at some of my early underwriting and I'm like, man, this wasn't very good. but as what are you looking for now? Like, say, hey, I still bought some C's. I'm still buying B's. Like, what do you guys win market rate deals, obviously, which means most of the time you're the high bidder or at least close to it. What are you looking for, and how have those yield requirements changed over time?
They've certainly come down. And I mean, I don't know if I'd say high bidder. We may have some equity partners on the call. I tell them every time that they just love us. I don't know why.
Among the high bidders, you're
just
really not the lowest on the matrix.
No, I'm just kidding. Yeah, so return expectations have come down. There's no doubt. I would say we underwrite most everything to a net to investor, between a 14 and 16 net to investor IRR, and that's over a 5-year hold. And we've been able to attract capital at that level. I mean, we used to underwrite to a 20. We have to stretch to get to a 16. So, and I think if we were doing true kind of institutional type deals, I think that's even, 12, 13 IRR, but what we're seeing is 14 to 16 kind of can get done.
Yeah. Okay. So let's talk about the equity. So, initially you're like, oh gosh, I have no idea who to call. Let's call everybody we know. And you throw in 50 or you throw in 25. How has that evolved over time? I know you still raise friends and family money, but how have you expanded your equity relationships, and what does that look like now?
Yeah. And I think that's been a key aspect to kind of the evolution of Knightvest as we, buy nicer and bigger deals is we have a variety of equity sources. Like you said, we started with the, kind of high net worth, or I wouldn't even say high net worth, just net worth, friends and family, moved into the high net worth realm. We've moved into the family office, and for the last few years, we've had multiple different institutional capital partners. So, we certainly have the groups that are easier to work with, and but we also want to be smart, because we had an institutional partner that we did a number of early deals with, and then they called us up and they said, well, we're out of multifamily right now, or we're between funds, or we don't like Texas. And so that's a problem for us if that's all we do. So we have a variety of sources, feel like I know kind of what they're trying to do, and try and just match the right deal with the right partner.
Yeah. Yeah, no, that makes sense. Well, so we've talked a little bit about some of the highlights and some of the lowlights. Maybe can you touch on some mistakes that you made early on that maybe held you back, or that you kind of learned from and helped you kind of progress?
Mistakes is, literally how much time do you have? Keep in mind, we started with, zero experience. So, we made all of them. I would say that the most common mistake that we try not to keep making, but we've even made recently, is under budgeting the CapEx to upgrade these apartments. The costs just go up. It seems like our tastes keep going up. So the level of finish out that we're doing just keeps going up and up, which means we need more money. So I would say undercapitalizing. Our first deal, we had spent our capital budget, and we still had, 20, 25 apartments that still had boards on them. So that's a problem. Overdoing distributions where you distribute all of cash flow, I think that's a problem. We've made that mistake. I think the thought that you can upgrade apartments out of cash flow, I think that's a problem. I just recommend fully capitalizing your deals day one. Have plenty of cash in the bank. Those are kind of the main ones. Yeah,
no, that's great. And for those of you guys on the call who don't, or are not aware of kind of Knightvest renovations, these guys are among the absolute best renovators of apartments out there. And so I can understand when you say your tastes change or get more expensive. It's, there are some really nice deals out there, and you guys are generally leading the charge. So yeah, that makes sense. So let's shift gears and talk about kind of current crisis at hand, right? So you didn't necessarily fully experience the last recession, but you were coming out of it. You saw what a lot of people did wrong with maybe some of your early deals that got them into the mess they were in. So COVID-19, how was April across your portfolio, from a collections and leasing standpoint? And how do you index that? What are you really comparing it to?
Yeah, that's a good question. So I've got some notes on that. I figured that one was coming. Other than the freak out session that we all did, me included, the sleepless nights, me included, of this is in late March, of what is April going to be? You had the rent strike that you saw. Everyone was freaked out. People projecting 50, 70% of normal. If I had fallen asleep and then woke up 60 days later, I wouldn't have known anything happened. So in April, we were about 98% of the trailing 3 months, January, February, March. So I think we're 90.
Is that rental income or total income?
Total income.
Total income. Okay.
Backing out late fees, we didn't charge late fees. So that's kind of an unfair zero versus whatever. But, really apples to apples, we collected most of the rent. And the vast majority, Phoenix, for instance, was our best market, and it collected over 100%. Which is somewhat shocking. Even Houston collected 95 plus.
And what markets are you in?
So we're in the majors in Texas and Phoenix, and then we're moving to North Carolina. That's our new market kind of this year.
What about leasing?
So leasing is another one that's somewhat fascinating. And I didn't adjust it for the busy season. So I didn't know how to do that. I'm just looking at the raw number. So net applications, people that are moving pre-COVID, we averaged about, this is portfolio wide, but about 300 net applications a week. Last week we had 318. In fact, we've had six straight weeks of increased net applications. And now we did remain open. So there could be some noise there. I know some of our competitors decided to shut down. We remained open, so we could have picked up traffic there. But now traffic, the first few weeks of the shutdown were pretty scary low. Ever since then, it's been ticking up each week. So 6 straight weeks. And then, in fact, I looked at this. Last week was our second highest traffic week as far as emails, calls, walk-ins that we've had in 2020. So last week was our second highest week. So again, I don't know, I can't explain why. I mean, I've got a bunch of theories, so is everyone else. But obviously our renters are not CNN watchers because they don't think the world is going to stop rotating.
Yeah. So April was great. And I think, we've certainly heard a lot of April's better than I expected. Oh, but what about May? I'm scared May is going to be worse. And give us a quick snapshot of May so far.
May's better than April, pretty much across the board.
Wow.
May's just better than April. Honestly, if you hadn't told me we had a global pandemic, if I looked at our financial statements, I wouldn't see, I'd see a little weakness, but nothing that would make me even question.
Did you guys halt distributions initially?
We halted April distributions. May's distributions are starting back up slowly, but I'd say the majority of the properties are starting back up. Some may be a little reduced amount. And then we think June, if we continue to be on the same trend. I mean, obviously this assumes the everything stays, opening up and on that same path. I think we'll be back to, normal-ish in June as far as distributions go.
Yeah. And y'all do monthly distributions?
We do monthly.
Yeah. Okay. So for some folks that say, hey, maybe the stimulus money is artificially propping up the entire apartment industry right now, is that not necessarily what you're feeling based on what you've seen? I mean, obviously the collections have been very strong, but do you have any concerns about June or July at this point, given what you've seen?
No, I don't. Honestly, I don't. No, I do. If we stay in kind of lockdown mode, I have more concern for October, November, December than I do June, July, because the unemployment is going to last. I think it's through July.
Yeah.
So I think we'll be fine. I really do.
One of the topics in our last webinar was how much kind of operational reserves do you like to keep on hand for each deal? You also talked about earlier being a little undercapitalized as a mistake that you made early on. Do you have a rule of thumb for like kind of cash on hand or a rainy day fund or something like that? Or is it just kind of property specific?
Oh, I mean, I would say that's probably a criticism that I get some. I mean, while I'm, aggressive in some aspects of the business, when it comes to keeping cash on hand, I'm probably lean towards too conservative. So, I mean, I really like to have $250,000 of free cash at all times. Now, obviously, our deals are larger, so if you're talking 100 units, I wouldn't have that. But I think having a couple $100,000 of cash at all times is prudent. And we try and do that. We over raise equity on the front end. I know it, dilutes returns and ultimately promote. And that's perfectly fine.
Yeah, no, that makes sense. Okay. So I know right now you guys have been active on the acquisition side, and a lot of investors right now are frozen. A lot of investors were frozen in 2009. What is your attitude or mentality when it comes to acquisitions in a market like this? I mean, how do you time the market correctly?
Yeah, and that's a good question. So we've said for years and years, we want to be buyers in both up and down markets. We want to be buyers and sellers in both up and down markets. We know we do the operations well. We know we do the renovations well. We can control that. We cannot control, a lot of other things. Interest rates are obviously what's going on right now. So we are buying and selling. Institutional capital is largely, not always, but not totally, but largely on the sidelines waiting for what's going to happen. My personal view is we are not going to see the 2009, 2010 bloodbath in apartments that we did then. And I think a couple of reasons. I think one, we're not seeing a decreased amount of cash flow. And if you have floating rate with a Freddie floater, your cash flow may be up. because LIBOR has gone down to, I think today it's at 20 basis points. I mean, heck, we've got a loan that's LIBOR plus 150, no LIBOR floor, so we're paying 170. Well, why would we sell that deal at a discount? And the answer is we're not. So like our portfolio, we're just not going to sell a lot of things, but there's been a ton of capital raised for multifamily. So I think there's going to be the simple economics of too much money chasing too few deals. And I don't think we're going to see the bloodbath that some are predicting. And I could be wrong. I'm wrong plenty, but that's my thought.
All right, got two more here, and then we'll turn it over to Bard with a couple of audience questions here. You talked about entering North Carolina. That's your new market. How do you arrive at a decision to enter into a new market?
I'd love to tell you that we spent, months and months researching. We did some research. I mean, obviously we want the majors. If we need a market that's growing in population, we need a market that's large enough that we can have a regional office. We want to be in a business friendly environment. And so you start, California gets X pretty fast. You start looking at your options. We looked at Atlanta similar to Dallas, and it's really more of a process of elimination. Really like the fact that the educated workforce and quality of life, and we just started narrowing it down, and we landed in North Carolina, which is honestly the place. It's not like we're some crazy research. It's the spot that most of us would land if we did that same type, 3 weeks of research.
Yeah, no, that's great. So just kind of a little parting words of wisdom, and then again, Bard will jump on with some questions. So again, 10 years ago, you're literally like a lot of folks on this call today. Hey, I want to have a future in multifamily, big dreams, big goals, eager to make something happen, raising equity and $50,000 increments or whatever you can get. What's one kind of, if you had one little takeaway for somebody today, actionable advice that you give folks that are looking to build over the course of the next, 5-10 years? I mean, what would you tell them?
Yeah, I mean, and we still raise $50,000 increments. I mean, you just don't get away from that. If you're in the capital raise business, I mean, I had a call before this and I have a call after raising money. I mean, that's pretty much my primary job, especially having deals under contract now when a lot of capital is more hesitant. I think the main thing I would say is treat it like a business. I don't treat it like I'm a real estate guy. I treat it like a business. Head down, do the right things day in, day out. It's as simple as that. I mean, it's hard to do, but it's simple. Treat people the right way, do what you say, work hard.
Yeah. No, I think that's great. Bard, why don't you hop on and unmute yourself and give David a couple of questions from the audience here.
You bet. David, thanks again for joining us. Okay, so I know you have 5 or 6 deals in escrow right now. So what kind of debt are you looking to put on these deals?
So the deals that we have, we're doing agency financing. As a rule, we're doing agency financing. And so I realized the COVID escrow kind of freaked people out a little bit. Keep in mind, the way we do our deals is we raise all the money day one. So we have one deal that has a $4 million capital budget. We raise it all up front. And then Freddie's like, well, you have to put $1.5 million in escrow. That's fine with us. We just take it right out of our capital budget and we're not going to need that money anyway for a few years. So that hadn't really bothered us too much. I think one of our deals, we were using a life company. It's a little bit higher leverage, but they have a LIBOR floor. But we're getting, I feel like we're getting obviously amazing rates. We're getting, a little less leverage today, but it seems like it's loosening up.
Are these fixed rate deals or floaters?
These are floating.
Okay, another question. So as far as raising equity, I know it's gotten more difficult now. So have you changed your strategy as to raising equity and maybe change your yield requirements a little bit, tweaked it a little bit since post-COVID?
We haven't done that. So our overall deal with equity has not really changed from the last few years. So I've told a bunch of partners, I'm like, hey, a few years ago, it's like the power is in the deal, right, in the operator. So I'm giving you the same deal that I always have. One day, and that day is now, one day the power will shift violently to the equity. So I want you to remember that I didn't change it on you when I could, so don't change it back on me when you can. And I think that's resonated with a lot of people. So, I mean, and the truth is I could have charged bigger fees. I could have charged better splits the last few years, and I hadn't. So hopefully that'll happen back to me.
Okay, so those equity partners you mentioned, do you have them sign for the carve-outs, or are you the only one signing for the carve-outs on the loan?
I'm the only one signing.
You're the only one. Okay. Mm-hmm. And then how do you source deals? And how do you, if it's a competitive deal that's marketed, how do you win these deals? How do you sell yourself to the seller?
So we're in fewer markets, and now I'm giving you my trade secret. So hopefully I don't have 1,000 competitors tomorrow, but we go deeper in fewer markets. And so we have a Dallas, their DFW acquisitions person. That's their job. Their job is to find deals in DFW. And, we have the same thing in Houston. We have a Houston office. And so his job is to hang out the brokers and know every deal. Same thing in Phoenix. And then we'll have the same thing in North Carolina. So I know a lot of groups will try and do acquisitions from a hub and then branch out. Our view is we would rather have an expert on the ground that's local to the market that can get, hopefully the first look, hopefully the last look, off-market deals if possible. I mean, one of the deals we have under contract right now is off-market. That doesn't necessarily mean you're getting a better deal, but it certainly feels like you're, it feels like you're trying harder. That makes sense.
Sure. So how are you underwriting projected rent growth now over the next 12 months, let's say?
0.
Flat. Okay.
0. Zero organic growth through 2020, kind of our underwriting.
So are you modifying your business plan as it relates to interior upgrades and the amount of capital spent on these properties?
No, not yet. We haven't. And we normally don't see, if you think about it, we're going to buy a couple deals in June. First month is July. So we would be renovating anyway. We wouldn't expect huge rent premiums until we're finished with the exterior renovation, the common area, and the office. So sure. It doesn't really impact our underwriting. Now, if we get in and we're not getting paid, we'll certainly alter our plan and we'll scale them way back if we're not getting paid for the renovation.
Sure. So there's a lot of questions about is this a buyer's market? Do you think cap rates are creeping higher? I mean, what is your perception moving forward over the next 12 months as it relates to a buyer's market versus a seller's market? Has it really changed that much?
I don't know. I think cap rates will be lower, not higher. That's what I would really believe. If you can get a deal done today, it's probably going to be a buyer's market, but I don't think it's going to be a bloody market by any stretch.
Okay. And how many units do you think it takes to justify breaking off and self-managing and starting your own management company?
Depending on how broke you are. If you're as broke as I was, it's like I do nothing and I make no money. If you've got a full-time job or if you have a larger, monthly obligation, that's a good question. I mean, it's probably 3 to 5 deals, 1,000 units. I don't know.
All right, Bard, last one. What fire him a fastball now. I mean, these are too easy for him.
Oh gosh, I don't really have any true fastballs.
I like it better between Nick and Bard.
Yeah, there you go.
Please. Who's a better golfer?
I knew you were going to go there. I knew you were going to go there.
So I guess, do you just underwrite to IRR or do you look at cash on cash? And if so, what kind of cash on cash yields do you underwrite to?
We look at we look at the IRR, we look at multiple, and we look at cash on cash. I mean, I don't know that we have a straight rule of thumb. I mean, we want to be double-digit cash on cash by the time we're fully renovated. So whether that's year 3, that's certainly a rule of thumb. I see Casey just asked a question on this box. Don't ask that question. Whatever he asked.
He said, "Do you think rates will go negative?"
Yes, he actually owes me big money because I said that rates are going to go sub 1 before they go over 3, and he hadn't paid me, so he owes me big money.
Gotcha. Okay.
Well, David, thank you very, very much. I know it's, even though I know a lot of us have some extra time right now, I know you guys are fast and furious. I know it's raising equity, like you said, is a full-time job. So thank you very much for joining us here. And Paul, we're going to kick it over to you for the second part of our presentation here.
Sounds great. Thanks, Nick and David and Bard. What a great presentation by David. The quality of his rehabs are really spectacular. A lot of people that who purchased his properties from after they had done the rehab were very happy on how well they had done. So we appreciate David Moore being on. I'm Paul Peebles. So remember, if you got here a little bit late, we are recording this, so we'll try to push that out to you the next 48 to 72 hours. So we have 3 great guests today. So they'll have a large impact on your business, and let's kind of talk a little bit about that. We're going to go probably another 30 minutes or so. So just for timing, just know how long we're going to talk. So these 3 guests, we're going to break them down to 3 different topics. One is going to be property taxes. Property taxes have become the most significant factor in affecting your profitability, operations, marketing, and ultimately the value of commercial real estate. So in fact, property taxes are the largest expense item, and you want to lower your annual property bill. Who do you call? Well, here in Texas, you call Mark Cantrell with Cantrell McCullough. They represent you with the taxing authorities. They founded in 2001. CMI is one of the largest property tax consulting firms in Texas, representing billions in overall values of properties in thousands of properties. So we're also going to have Patrick Nugent. He's with Commercial Insurance Solutions. CSI is a full-service insurance brokerage company, and they're based here in Dallas. He insures different property types, but mainly focuses on apartment buildings. So he's an expert in finding the right solution for the client. So Brian Hammer is a real estate attorney with Borland, Wall, Wenzel in Fort Worth. Brian assists clients in all aspects of commercial real estate and acquisition sales, the due diligence, title survey reviews, and he also advises clients on legal issues such as tenant evictions during this period of time, specifically on the coronavirus. So remember, if you have any questions, please type in the question and answer portion of your screen. And so I also want to bring on James Zhang. So James, unmute yourself, and he's going to help us ask a few questions of the guys. And so we're going to kind of go through it one at a time. We'll start off with Mark. And so Mark, unmute yourself if you can. Mark, most taxing authorities have pushed out annual tax valuations in the last month or so. 2 parts of that. Is there any relief coming this year or next? And B, are the appraisal districts understaffed and willing to settle at a lower valuation?
That's good questions. I don't see a lot of relief coming in 2020, according to our contacts with all the different various appraisal districts across Texas. No one's really wanting to acknowledge COVID in 2020 because their job at the appraisal district is to assess values of January 1, which that was pre-COVID-19 in the U.S. So we're seeing a real aggressive notice values. Once again, this year, we have our notice values in Harris County. Across the board, they're 26.5% increase over 19. Denton County, they're notorious for having pretty aggressive increases the last few years. Their increases for multifamily this year is 26%. Tarrant County, again, has been one of the most aggressive counties in the state of Texas the last few years. Their increases this year are 16.7%. And then Bexar County is 6.2%. They did not get very aggressive, only in the 60s product. We don't have Cullen or Travis yet. Dallas values are going to be out the latest of any of these other counties. They're coming out May 15th, which is Friday. But we were able to see, if you have your consultant was able to see your value April 15th. They let the consultants see their portfolios at that time. This is pretty shocking that the Dallas County increases for multifamily for our portfolio totaled 43.2%. That was the average increase, 43.2%. Most of the huge increases were in the 60s and 70s product, also some in the 80s, but we saw over 60% increases in our portfolio over 60s and 70s product. And we represent more properties by a pretty wide margin than our competitors. And so I think our sampling of the market is a pretty good representative of what is going to be expected for the entire county.
Mark, besides, hiring a good property tax consultant, what can owners out there do to help that tax consultant when they go in to fight these values?
Okay, good question. Well, what we're doing this year, we always ask for the year-end P&L, year-end rent roll. That's really required, and that's what we provide to the appraisal district. Occasionally, we won't provide any income and expenses because that's what the client has asked us to do. They would rather us to look at the value of the property more on the equity argument and not income and expenses. But we ask for the year-end statements so we see what the property looks like. This year, we're asking for the April collections and then also for the May collections and May rent roll, because we really want the appraisal districts to review what's currently happening with COVID, because we're seeing, unlike David's situation where he had a really good collection across his portfolio, we're seeing in a lot of our Class C properties, the average per Dallas is about 74% for May collections, 74% of what the revenue they were expecting to collect for the Class C, the older product. And for the properties that maybe have management that's not as in tune with being on the property and doing the virtual tours and all that, they're more the mom and pop managers. They're struggling a little bit more than the more sophisticated operators. So we're trying to take a look at the current environment and really stressing when we go to the appraisal district, we can't just use last year's numbers. We've got to acknowledge this year's numbers. And it's going to be interesting to see what happens. We don't know. There's a chance that these operations that we're seeing now that are in decline are only going to be picked up next year when the values are assessed as January 1. And so you'll be able to see the income declines and be able to get the benefit for 2021. But we're doing everything we can to try to get the benefits for this year.
Mark, we're going to come back to you in a second here. Let's go over to insurance with Patrick. Patrick, insurance was, when we underwrote these deals, at $300 a unit. Now it's closer to $400, $500, $600 a door. What's driving the increases on property insurance these days?
Yeah, it's a super challenging environment right now. I think we're working every deal harder than we ever have right now. There's just not many players in the marketplace after many, many years of these carriers just losing money underwriting deals. They finally have exercised some discipline and said, we're done. We're getting out of the business. We're getting out of that asset class. We're reducing our capacity. And London got out of right and frame hab, and that really threw a big wrench in the whole system. But really, the increase has been driven by underwriting discipline, not lack of capital, which is unusual. So you've got folks that are just, their no muscle has gotten a lot better, and they're shedding older assets, saying we don't want to have the 60s and 70s properties on our books anymore, and they mean it. And really, that's what's driving it. And it's not just in property; it's general liability and umbrella is through the roof right now, and it's really not so much multifamily driven, but it's driven by other asset classes and other lines of business that are having huge claims, and everybody has a piece of a piece in this business. So they're just driving rates like crazy, like doubling on some umbrella rates that we've seen. So we've got a lot of headwind right now, and we're doing everything we can. It's just in the Dallas-Fort Worth area right now, North Texas, it's really, really, really difficult to get a quote on some older properties. It's super tough.
If someone sent you a deal, what would you plug in right now sort of for first cut on insurance, dollar per unit for like 100 unit, 200 unit deal right now? Right.
So just real quick, I mean, I know you guys think on a per unit basis, which is great. So we have to kind of extrapolate the numbers and get back to that, because the way the insurance is written, GL and umbrella is written on a per unit basis, so that's fine. But the property is written on a valuation, so per $100 of value. So we have to come up with that rate times the valuation, and then we'll divide it by the number of units. So it's really all over the place. A 100 unit deal that averages 700 square feet is going to underwrite. It's going to be less per unit than a similar place across the street. It's exactly the same, except it's 950 square feet per unit. So the per unit price is it's hard to talk in those terms, but I know I saw a deal today that I thought was a pretty good deal for $350 a unit. Now it was more like 800 units or 900 units, but I mean, it also depends on exactly where it is, how it's built, how the roofs are, what the loss history is. There's so many, it depends. It's like saying, how long's a piece of rope? Well, it depends on how long a piece of rope is, but I mean, I'd start at 350 and go up for sure.
Yeah. Talk a little bit about roofs. I mean, we've heard just interesting stories about roofs. I mean, are you really self-insuring on your roofs these days?
Well, pretty much. I mean, right now, the going rate in North Texas, and I know there's people probably from all over that are listening to this, but, in the part of the country where bad things happen, bad perils exist. So here, Oklahoma, throughout the Southeast, Colorado, they're underwriting the wind more like a cat exposure. So you're getting a percentage deductible. And so the way that works, it's applied towards your total insurable value of your property. So, yeah, I mean, 2% on a $20 million deal is, you may not be totally self-insured, but the first $400,000 is going to be, you're toting the note on that. You're self-insured. So, and they're trying to go to 3% up here. I saw a quote today with 3% and think, 2%, 3%, not a big deal. But if you do the math, you're talking six figures a lot of times, easily six figures on the potential if you have a claim. So it's tough. It's super tough. And I'll tell you, another hot button right now are these stab lock breakers. It's kind of the underwriters are kind of seeing ghosts, but that's their deal. Kind of the aluminum wiring of 2020. But these stab lock breakers, if you have older properties and they've got stab lock breakers, or if you're trying to buy one that has them, you better figure it out pretty quick, because if it's got stab lock breakers, that's going to eliminate 99% of the carriers. So you're going to be left with one or two carriers. It's going to be very expensive to insure them. It's very expensive to replace them, but you got to do it. So that's something I think everybody out there needs to be watching, whether it's on your current asset or what you're looking to buy is, and y'all can email me. I've got articles that talk about them, and it's kind of some people don't think they're that bad. Some people think they're super bad, and here's what they look like. And they say Federal Pacific FPE on the front of them, or stab lock. And there's another company called Zinsco breakers, but that's a hot issue right now. And if you're buying a deal, I'd retrade hard if they have those, because it's going to cost you probably $500 to $800 a unit to replace those.
Brian, what's going on with contracts? Some of these, through COVID-19, we've kind of gone from a seller's market to now a buyer's market. And what type of language are you telling your folks, if they're even writing a contract these days? What type of additional language are you putting in those contracts to help buyers out?
You bet. So the number of contracts or number of properties that are going into a contract has certainly decreased. I think there's some people that are sitting on the sideline trying to figure out what's going on with lending, what's going on with the market. Plus, in my experience, when something like this happens, there's usually a gap for a period of time between what a seller is willing to accept and what a buyer is willing to pay. That said, we do have properties still going under contract. We're working on some at all times, and we have changed what we're doing a little bit. The hard money has certainly decreased, if not gone away altogether. We have included in some conditions of closing, if we don't feel like we're getting, when I'm representing the buyer, I should say, if we're not getting a discount on the pricing because the seller believes that their property is fine as far as the rent, we've been using some net rental income covenants in the conditions of closing. We have been building in financing when we can get it as a contingency. We also are looking at adding some extensions on the closing date, just because you don't ever know what's going to happen between here and now, quite frankly. And so we try to build in a little cushion there. As far as COVID-specific requirements, title insurance companies have started adding an exception recently that basically provides that they don't have to issue the title policy if the recording office is closed. Every lender, every buyer is not going to be willing to close without title insurance. And so we can everybody is usually willing to agree to that type of provision that provides that the closing date is going to be automatically extended until the title reopens so that we can get a recording and a title policy issued.
What about all these courts being closed for evictions? What have you seen owners do on that?
Well, so that's going to be it's really going to be a case by case basis. The situation with the evictions is tough, obviously, for a whole variety of reasons. But Texas, taking a step back, Texas generally compared to other states is a pretty straightforward residential eviction state where you post your notice to vacate, you file your eviction action, you get your hearing, court issues a writ of possession. They post the writ of possession. Tenant has 24 hours to get out. I've oversimplified that a bit, but it's not a terribly complicated process in Texas. But right now it kind of is, because you have multiple layers. And so let's say someone has a multifamily property in Dallas, Texas. Well, now there is a Supreme Court order that says there can be no eviction hearings or writs of possession issued, eviction hearings until after May 18th, writs of possessions until May 25th. But if this property is in Dallas, you also have the Dallas County order, which has stopped all eviction hearings until the first week of June and has imposed a cap on late fees of $15 per month. In addition, if this property is in the city of Dallas, you have the city of Dallas order that they put in place at the end of April, which now provides that you provide a tenant a notice of possible eviction. The tenant then has 21 days to say that they're unable to pay the rent due to a COVID-19 financial impact, and they're supposed to provide objective evidence to verify that. And if they do that, then they have 60 days to try to work out some type of payment program with the landlord. And then layered on top of that, yet again, is then you have the CARES Act. And so most of the people on this call probably have Freddie, Fannie, HUD type of debt, and that imposed a moratorium on even being able to issue a notice to vacate of 120 days. So you can't do that until July 25th. And then on July 25th, you now have to give a 30-day notice to vacate. So the eviction process is certainly complicated by all of the various restrictions that have been put in place. But it really varies on location of where the location of the property is.
Bard, I'm not an attorney, but I'm going to pass the witnesses on to you right now.
Okay, thanks, guys. Okay, I'll start with a question for Patrick. What year did builders stop using stab lock breakers?
You know what? That's a great question. I think it was around 78 or 80, somewhere in there. I don't know the exact. I can try to find out. And
late 70s, okay, to 80. That's what I thought as well. Another one for Patrick. Do you recommend higher deductibles to lower costs?
Yeah, I mean, that in theory, that works great. But at some point, the carriers can say, look, this is the premium we need in case something really, really bad happens. So going from a 25 to a 50 to 100 for all of the payrolls, that's going to help you a little bit. It may not help you. I've had some lately where it didn't offer as much relief as I thought it might. But it's certainly something to work about. We try to give folks options. Another thing you've got to look out for lately is a lot of the lenders are being really difficult with valuations and what they're requiring for the insurance or the carrier rating. And that's something that you need to get your broker involved in pretty early, because we can push back and kind of explain, well, here's why your valuations are too high. And a lot of times that'll save quite a bit of premium because the premium is just a function of your value. So a lot of times the lender's insurance department is not quite as sophisticated as we would like. And we have to do a little bit of educating, and we've had some success doing that.
Well, the other part of that deal is that the lender's going to require a maximum deductible on that too. So you can't do $200,000 deductible. Fannie Mae and Freddie Mac are going to have amounts that you have to go up against. So it's got to fit into that box. So don't forget about that. Next question.
Yeah, by the way, we've had a couple of renovators chime in that stab locks are still found in early 80s product. So just FYI, I think early to mid 80s, they for sure stopped using them. But you certainly see them in older assets.
Okay, this next question is for Mark Cantrell. So as these values have gone up this year, and I know that they came up with the values in January, pre-COVID, and now everybody's, a lot of people are struggling on their assets, and then they get banged with a higher assessed value on their property. So everybody's mindset, it seems to be, is that there's going to be more litigation this year, and municipalities' budgets are pretty tight right now. So do you see them settling quicker, more efficiently this year?
Yeah, we think since we can't have RB hearings in person, we're having those on video conferencing. And we feel like the appraisal districts may want to settle values a little more informally than having to go to the ARB review board hearing. But to preserve your rights to litigate, you do have to get a ARB hearing or a value so you can litigate the value. So I think we're going to see a lot more litigation, yes. But I do think that the appraisal districts are going to be reasonable. They always are, but I feel like they're going to be reasonable this year. It's just going to be tough in some of these counties. Dallas has cap rate compression. It's probably long overdue. They've been valuing deals 8.5 cap. And so I think you're going to see them being a little more difficult, trying to have cap rates that are a little bit more in line with the market. So I don't know exactly what's going to happen there, but I do suspect there will be more litigating. It's kind of a long answer to the question, but.
No, that's great. That's great. So this is a question for Brian. How do you see hard money? You know, we had a lot of deals that were in escrow. Everybody did. And then the buyers had to pull out for various reasons, whether it was equity or debt or, you know, their business plan has changed because of flatline rent. So, and they had non-refundable money. So how do you see that working out? Buyers all think that their money is now refundable because of COVID. Sellers still think that it's non-refundable. And so, and then moving forward as we get into, let's say, the fall of this year, and let's say there's something happens again and people have hard money, how do you see this all shaking out?
So that is definitely an issue, and probably depending on whether you're a buyer or a seller, you have a different opinion as to the answer to that. And I have clients on both sides of the issue, but generally speaking, it would be unusual for a purchase and sell agreement to have a force majeure clause. And if there was a force majeure clause, it would be pretty unusual for there to be a pandemic provision. It was what I would consider to be a pretty seller-friendly market, at least going into March. And so it wasn't unusual for contracts to have hard money, non-refundable upon day one. The typical carve-outs would be potentially material title, environmental, casualty, condemnation. There typically was not a carve out for decreases in occupancy, decreases in net rental income. So generally speaking, I think the hard money is hard. And if the contract winds up being terminated, the money would go to the seller. The good news is, generally speaking, in Texas, certainly the standard in Texas for a commercial real estate contract would be that is the seller's only remedy, is to keep the earnest money, and they shouldn't hopefully, depending on the contract, shouldn't be able to sue for damages or anything beyond that. But most likely the money on these contracts that were pending at the time that were entered into pre-pandemic, that earnest money is probably going to, if it's probably hard.
Okay. Got it. Mark, question for you as it relates to Harris County. So oil prices had already started dropping when they were coming out with their values in January. How do you see Harris County and Houston, MSA in particular, with 2020 assessed values?
Yeah, that's a good question because Houston's getting hammered by both COVID and the oil situation. And so it's going to really be for Houston as the city's a huge deficit. The county's having problems. Of course, the schools will be involved in that as well. So they're reaching for as much money as they can with the property owners. But as you said, problems with the operations and so forth going forward more so than going backwards. So it depends on 2020 values yet. I just don't know what the environment is exactly going to be. I expect that we will get values back down close to last year's values, but who knows at this point? It's still too early. Again, lots of litigation.
Yeah, can I have you just ask one more question? And then I'm going to throw over to have James finish us off and just what the capital markets is doing, and then we'll call it a day.
Okay, so last question. We're getting a bunch of questions on insurance for Patrick, and increases. People feel like they're mainly based on hail claims. That's where the insurance companies are getting dinged the most. So is there anything owners can do to mitigate that? One gentleman asked, can you put a metal roof on the asset and will that reduce insurance costs, or is there anything else?
I don't know about a metal roof, but there are some heavier duty shingles that you can certainly put on your properties, and that's part of the underwriting. And we'll make a big case and go in with all the information, and that should help make the underwriters more comfortable with it. It's going to cost a pretty penny to do that, but if you're putting a new roof on anyway, it might be something worth looking at.
Okay, good. And then as it relates to that last one, wind and hail coverage and a buy down on that.
Right.
Do you recommend that?
Well, sometimes most people, when they buy the coverage, so right now we're say it's a 2% wind and hail deductible. If they want to have it at 100,000, we can get it there. We just have to buy the difference between what 2% would be and $100,000. So sometimes the lenders are driving that. Usually they are. Most people on their own are not going to choose to spend that money because they think, well, I'm not going to have a claim anyway. But we actually have an in-house wind buy down program that we've probably, this year alone, we've probably, I don't know, booked $900,000 in premium just buying deductibles down to a certain level. And it's a kind of a rule of thumb is the difference from where you are to where you want to be, about 10 to 12% of that is about what it's going to cost.
Thanks, Bard. Nick, if you could throw up the slides, I just got a couple slides here. I wanted to share just sort of what we're seeing on sort of the Fannie side. And so they put out this once a week now, and they really talk about, what loans are in forbearance already because of COVID. And so last week their first report came out in April, and they had 29 loans totaling about $370 million. And then this last week, they came out and essentially doubled the number of loans and totaled close to $1 billion in forbearance. So, this is one step away. I don't think you had to see a deterioration in your property's collections, and you pretty much couldn't do a capital call. So these deals are going to have some trouble. On the second slide, we really get into Freddie. And so on the conventional side, they only had about 0.5% of their loans in forbearance. But then on the Freddie SBL side, they had close to 3% of their loans in forbearance. So on the next slide, we talk about CMBS, and you can see that huge red line. That is the people who didn't make their payment who have CMBS loans backed by hotels. So that was about 20% of the loans. And then the second one behind that is retail, and then multifamily is about 5%. And then the next slide goes into year-to-date losses. I thought this was interesting. First you do forbearance, and then eventually the lender has to write off the asset and write off the loan. And these were the largest loan losses on the CMBS side. And you can tell, luckily, there was no multifamily on here. So it was really hotels, office, and retail that really lost anchor tenants. And so just be grateful you have a diversified tenant stream at your property. And let's just go to the next one. This one is agency lending. So agency lending for Q1 came in about 20% lower than it was year over year. And they are seeing a huge decrease, obviously, in April on acquisitions. And now 85% of their quotes are refinances. And so let's go to the last slide. And so on the forbearance, we've covered this before, but 90 days, they're allowing you to not make a mortgage payment, but you have to pay that back within 12 months, principal and interest. And then you're not going to be able to do a new loan with them, and they're going to cash flow sweep everything in excess of your property expenses. And then on the new loan side, Fannie has 12 months P&I, essentially any loan over $6 million, along with taxes, insurance, and replacement reserves. And they're going to hold that for a minimum of 12 months. If you go to a $6 million loan or under, it's going to be 18 months P&I. But I guess the silver lining here is assumptions right now don't require any additional reserves on the Fannie side or Freddie side. And then jumping over to the Freddie side, they're making you put up 12 months of P&I, and they are sort of doing similar to what Fannie does. They're pre-screening anything in sort of your energy or tourist-driven markets like Houston, Orlando, Las Vegas. And we used to be able to actually get exceptions on the Freddie SBL side for non-local borrowers and first-time sponsors, and they're pushing back very hard on this. And so you might not get that done. So you might have to just go with a recourse bank loan if it's your very first deal. And let's see. And then the last thing, they're going to look very closely at collections. So if you submit a deal, let's say before the 15th of a month, they're going to look at the previous month. But if you submit a deal after the 15th, they're going to look at that current month's collections. And if they see a drop of more than 10%, they are going to use a T1 on your collection number, which is going to hurt your net rental and your overall underwritten NOI. So just be very careful on collections when you go in for a property. So do what Brian did and sort of have maybe like a net rental number that the seller needs to hit throughout your contract. And that's it on the capital market side.
All right. Sounds great. Nick, finish us up, please.
Well, let me ask James one question, and then I'll take us home here. But James, as far as when the lenders are going to let up on these reserve requirements, I've heard a little rumblings that may be, happening here before too long. What are you hearing on that front?
So yeah, we've asked again. We checked in just yesterday with the top people at Fannie and Freddie, and the rumors are untrue. It is not dropping off like this month, and it has not dropped off. So I think they're going to stay in place for a while here, and probably towards the end of the year it might come off. And so I think they're going to need to see steady collections in the country open back up.
Yeah, no, that's great. Well, everyone, I sincerely appreciate you joining this call today. It's been another great webinar. Special thanks to David, Brian, Patrick, and Mark for joining us. The Old Capital team and the Marcus and Millichap team are here as resources for you guys. And please reach out if there's anything we can do in any way, shape, or form. And we would love to help. We will be sending this out in the next 48 hours or so, and would love to follow up with any of you if you have further questions. So thanks for being with us. Have a great day and stay safe.